Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of January 6, 2014. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you your update. Well, last week, mortgage bonds traded in a tight range and interest rates ended the week about where they started. If you look at the bond chart on the screen, you can see that tight channel they traded in with the black lines on the bottom and the top, which was capping it from going lower and capping it from going higher. So the bonds traded in that range. But what we're looking for is long-term trend is still for mortgage bonds to sell off and interest rates to move higher. But in the short term, with this tight trading range, we're actually going to recommend floating your Delaware mortgage rate to start the week because we're hoping to see if it can break higher short-term out of this trend and move interest rates slightly lower. But be on guard. If it breaks below that level of support, mortgage bonds could sell off quickly and interest rates could shoot higher very fast. So be on guard, but we are going to recommend cautiously floating your Delaware mortgage rate to start the week. Now, what is the outlook for 2014 for Delaware mortgage rates? Well, mortgage rates have been on the rise since May of 2013, where they're at a low of about 3.25%, and they've continually risen. Now, it hasn't been straight up. It's up, down, but the long-term trend is for mortgage rates to increase. Rates are hovering around 4.75%, depending on credit score and loan program. So that's a big move up. That's a 1.5% move up from last May. So where are we going from here? Well, mortgage rates are continuing to climb. They're going to go into the 5% in 2014 for two reasons. First reason is the economy is improving. So as the economy improves, it pulls money out of the bond market into the stock market. So when the bonds sell off and price goes down, the yield, which is the interest rates, go up. So as we move more money into the stock market, out of the bond market, the yields, the interest rates are going up. And the second thing is, what's been keeping interest rates low is that the Federal Reserve has been purchasing mortgage-backed securities, which has artificially inflated that bond price higher. So they've already started tapering their bond buying program. Last month, December, they bought $85 billion worth of treasuries and mortgage bonds. This month, they're cutting it by $10 billion. They're only purchasing $75 billion of treasuries and bonds. So that's $10 billion less in the market. That's going to put rates moving higher. Now, the Fed said as the economy improves, their goal is to keep tapering the program and to have it totally back to zero, ended by December 2014. So what that means is as the year goes on, interest rates are going to climb into the 5%. So what does that mean for you? That means if you're considering purchasing a home in 2014, the sooner the better. Get a sense of urgency. Get out there and purchase a home now. Two reasons. Interest rates going up, that's going to lower your buying power. The same house will cost you more money per month on the mortgage because you'll have a higher rate. The second reason to get out there and purchase now is home prices are again going to go up in 2014 just like they've done for 2012 and 2013. So as home prices go up, your affordability index goes down. Same house now costs more with a higher payment because of the higher interest rate. So two reasons, get out there and buy. Now let's dig into the economic news. Last week we saw consumer confidence for December 2013 came out, increased to 78.1. That's off the lows of October and November, which it dropped in October and November because of the government shutdown. So we're past that. Consumers are feeling better about the economy. Thursday, we saw the release of the weekly initial jobless claims. It came out at 339,000 claims, slightly lower than last week's claims of 341,000. And last week was actually revised higher from 338 to 341. So jobless claims remain in the mid 300,000s. We need to get those below 300,000 to get the labor market back on track. Big report coming out this Friday is December 2013 jobs report. They're expecting 197,000 jobs were made in December. If we hit that number or come out higher, that's going to be bad for bonds. It'll probably move interest rates slightly higher. If we miss the number and it comes out lower, that could actually help mortgage bonds. So, but we'll see. But the jobs report for the last 2 months has been coming out good, so there is no reason to expect it to miss. So another reason you may want to consider locking your rate at the end of the week. And then in housing news, the Case-Shiller Price Home Index for October 2013 came out and was up 13.6% year over year from October 2012. That's a very good number, but it's a bit dated because it is from October. The housing market has slowed down since October because of rising interest rates. So we're going to have to see how November, December come out for the home price index. In there was a prediction next year home prices are going to go up in 2014, but not double digit. We're looking for a 6% year-over-year appreciation, which is close to historical average. So still having a great housing market and looking for a housing market to be good next year. So it's still a great time to purchase a home. Now, in the local news, the next free first-time homebuyer seminar is in Newark, Delaware. That is Saturday, January 18th from 10 a.m. to noon. As at the Christiana Hilton Hotel, you can register for that event, but give us a call in the office, 302-703-0727, or you can apply online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.